So today, I will be explaining and illustrating to you the accounting cycle from worksheet to financial statement. But after the worksheet, we will proceed to income statement and balance sheet so that we have our basis for the preparation of a financial statement. So let's start with the worksheet. So our company name is Manor Malik. So for the month of December 31, 2016. So this is our account titles: purchases, carriage inward, wages, salaries, general expenses, cash at bank, petty cash, premises, furniture, stock, drawing, account receivable, prepaid general expenses, bad debts, sales, capital, notes payable, sundry director, salaries payables. So this is our adjusted trial balance. So our adjusted trial balance, our amount for the debit is 720, 930, 1,560, 1,220, 300, 1,600, 30, 6,500, 1,500, 550, 70, 1,200. And for the credit side, we have our 5,000 for sales, 9,500 for capital, 700, 240, and 740. So our total debit is 6,180 and our total credit is 16,180. So let's proceed to adjustment. So our adjustment, we have a 320 for purchases and credit side, 140 for salaries in debit side, 150 for general expenses and credit side, then 320 stock in debit side, 100 for account receivable and credit side, then prepaid general expenses of 150 in debit side and 100 bad debts and also in debit side. So our total debit is 710 and our total credit is 710 also. So as we notice that they are balanced, so that is correct. So let's proceed to adjusted trial balance. So we have a 400, 930, 1,560, 1,360, 150, 1,630, 6,500, 1,500, 870, 70, 1,100, 150, and 100. So that's all our debit. And for our credit, we have a 500, 9,500, 700, 240, and 880. So our total debit is 16,320 and for credit we have a 16,320. But before we proceed, I will explain to you why our purchases is 400. So let's just minus the purchases in an adjusted trial balance is 720 and 320 in adjustments, which is in credit side. So minus 720 minus 320, so we have 400. And also in salaries, 1,220 plus, but if they are the same debit, we just get the sum of them, and if it is debit and credit, so we just get the difference of them. So in salaries, they are both debit. So 1,220 minus 140, we have a 1,220 plus 140 rather, so we have 1,360. And in general expenses, they are not the same. So 300 for debit and 150 for credit. So get the difference of them. So we have 150. And then in stock, we have 550 in debit and 320 in debit. So get the sum of them. So we have 870. In account receivable, we have a 1,200 in debit and 100 in credit. So our account receivable is 1,100. So that's all. So let's proceed to income statement, which is income statement and balance sheets, which is our basis for the preparation in financial statement. So in income statement, we have just forward the amount of the expenses in the debit side and forward the amount of revenue in the credit side. So our expenses is purchases, carriage inward, wages, salaries, and general expenses. So our amount rather, we have a 400, 930, 1,560, 1,360, 150, and 100 for the bad debts. So that's all our debit side. And credit side, we have, which is the revenue, we have a 500 for 5,000 rather in sales. So our total debit is 4,500 and our total credit is 500. So minus the credit and the debit. So 500 minus 450 is 500. So we have our net income of 500. So let's proceed to balance sheet. So in balance sheet, we just forward the amount of the assets in debit side and the amount of liabilities known as equity in credit side. So we have the assets of cash at bank, petty cash, premises, furniture, stock, drawing, accounts receivable, and prepaid general expenses. So our amount is 1,630, 6,500, 1,500, 870, 70, 1,100, 150. So that's all our debit, which is the assets. And we have the credit, which is our liabilities and owner's equity. We have the capital, notes payables, sundry direct creditor, and salaries payable. And our amount is 9,500, 700, 240, and 8,800. So our total debit, which is the assets, is 11,820. And our total liabilities and owner's equity, or in the credit side, we have a 11,320. So as we notice, they are not balanced. So for them to be balanced, so we will add the net income, which is 500, to the credit side. So our total, so 11,320 plus 500, so we have our 11,820. So as we notice that they are both balanced. So let's proceed to financial statement. And financial statement consists of income statement of changes in owner's equity, and balance sheet. But we will proceed to income statement first. So our company name is Manuel Malit, and this is our income statement for the month of December 31, 2016. So our net sales. So our sales is 5,000, but we don't have any sales discount and sales return and allowances. Let's just forward our sales. So we have our net sales of 5,000, and less the cost of goods sold. We have our purchases of 400. Then we just add our carriage inward and wages. So we have our 930 in carriage inward and 1,560 in wages. So our total gross purchases is 2,890. Then our total cost of goods sold is 2,890. So less to our net sales of 5,000. So we have our gross profit of 2,110. So less the operating expenses. Our operating expenses is salaries, general expenses, and bad debts. So we have a 1,360 in salaries, 150 in general expenses, and 100 in bad debts. So our total operating expenses is 1,610, less to our gross profit of 2,110. So our total net income is 500. So let's proceed to the statement of changes in owner's equity. So our company name again is Manuel Malit for the month of December 31, 2016. So our beginning capital, which is 9,500. Then we just add our additional investment, but we don't have any additional investments, so we just put there a 0. So then add our net income, which is 500. So our subtotal is 10,000. So that's our drawings of 70. Then so our capital in the end is we have 9,930. So let's proceed to the balance sheet. Again, our company name is Manamait for the month of December 31, 2016. So as what I've said, in balance sheet we will need to simplify, and we will need to identify. We need to balance the assets and the liabilities in equity. So our assets here is cash in bank, petty cash, premises, furniture, stock, accounts receivable, prepaid and prepaid general expenses. So our cash at the in bank is 1,600, petty cash of 60, premises 6,500, furniture 1,500, stock 870, accounts receivable of 1,100, and prepaid general expenses of 150. So our total assets is 11,750, and our liabilities is notes payable. So our liabilities is notes payable, sundry director, salaries payable. So our notes payable is 700, sundry director of 240, salaries payable of 880. So our total liabilities is 1,820. So our owner's equity is only the capital, so we have a 9,930, which is the result in our statement of changes in owner's equity, which is our capital in the end. So our total liabilities in owner's equity is 11,750. So as we notice that the assets and the liabilities in owner's equity are balanced, so that is correct. So that's all my explanation of the accounting cycle from worksheet to the preparation of financial statement.